Strategy, joins us once again. So we've been visiting with you a lot lately to try and get a read on the charts because things change so quickly. I did notice today, though, S&P closed above 3,900. What's the significance of that before we get to part of your note?
No significance, Scott. S&P, NASDAQ, and the Dow actually closed at the lowest levels in more than a month. Gold closed at new two-year lows. We saw the 10-year yield almost closed at new highs for the year. So, hibernation is officially over yet again, at least for now.
So where are we going?
Well, I think in the next 3 weeks, we're in seasonally the most difficult part of the year. So S&P likely is going to pull back to near 3685 in my view. I see it proving short-lived because I think yields are close to peaking out. And so it's not going to be right to really avoid technology. If anything, you want to wait for that pullback over the next few weeks and consider buying dips in technology, in stocks, and also in bonds and commodities. For the time being, though, it's cash is king, and it's really right to be in king dollar and cash. I mean, those are really the two safe havens.
Cash is trash, is what Ray Dalio once said. I'm sure he has a different opinion of that now, considering he thinks now stocks can go down 20%. I mentioned Gunlock Miner. They're all in the camp of big decline coming. Why aren't you?
Well, a lot of that has to do with sentiment and with cycles, and most of those start to turn up pretty dramatically, or at least cycles do in the month of October. Sentiment right now is bearish, but we haven't really truly seen evidence of capitulation, and I think we'll probably get there sometime over the next few weeks on further deterioration. Our own Tom Lee has talked about the fact that, 6 out of 9 regions representing about 75% of GDP actually saw outright deflation last month, and a number of different CPI components are, well down off 18-month highs. So, that's something that the Fed simply isn't taking into consideration. They're looking at past data. None of us know what these interest rate hikes, what the effect will have in the future. It takes some time for these to work out. So, in my view, I think that, I'm no economist, but I think the Fed is going to be forced to pivot sometime in the next couple months, or at least, take their foot off the gas a little.
In the next couple of months. I mean, look, let's be honest with one another. Tom's been way too bullish. And I know, you have the name of the firm behind you, and whether you will suggest that or not, the facts are the facts. Tom has been way too bullish. The bear market is still intact. The trend is still lower. And there's nothing necessarily yet to suggest that it's about to change anytime soon. How do you counter that?
We are in a cyclical bear market as part of a secular bull market. And I think that, my own take, and which is similar to Tom's, is that the final quarter of the year is going to be positive. We both came into this year thinking there could be turbulence and really a rough first half, and then we would rebound. And so, Tom's point of view and time frame is certainly a lot longer than a lot of the day traders that are looking at a 2 or 3 week time frame. And so, I agree with a lot of his data points that say inflation is going to start to pull back pretty dramatically. And my own cycles start to turn higher from October through the end of the year. And whether or not we pull back early next year, we're going to save that for the year-end forecast. And we could pull back a bit more. But the next couple of years, I think, are going to be quite positive. So, I'm not sure what the fundamental catalyst is going to be. Either inflation starts to pull back dramatically, we see some evidence of a ceasefire in the war, or, who knows? But technically, people are bearish. The B of A report said that investors right now, over 50% of investors have underexposure to stocks. We're clearly seeing, bearishness not only from retail, but also institutional investors, which have clearly been caught, flat-footed, and everybody right now is negative. And I just don't think these negative earnings revisions have to happen right away. So, my thinking is give it 3-4 weeks. We're going to bottom out, and markets should be higher by year end.
Okay. All right. Good stuff. I appreciate the conversation as always, Mark. We'll talk to you soon.
Thanks,
That's Mark Newton, Fundstrat's technician, joining us there. Up next.